Hello and welcome to this special series brought to you by Bombay Stock Exchange Investor Protection Fund and the Money Mile. Joining me today is one of India's best known financial planners, Shweta Jain. Thank you very much, Shweta. It's always a pleasure talking to you. What are the different kind of assets, Shweta, and what are their key features? We do keep hearing a lot about equity, debt, gold, and we understand that these are the three main assets. Are there any other assets that investors, retail investors should look at? And if these are the three assets, could you tell us a little about what could be the ideal mix? Because people tend to see the price movement and then start changing their whole allocation. So could you tell us a little bit about these three asset classes and what are their predominant features?
So yes, Vivek, three predominant asset classes that each one of us usually has, and if we don't usually have, we should have in our portfolios. Gold by nature, most Indians have in physical form at least. So that is one asset class. Second is debt. For the salaried class especially, they have their EPF accounts. So some bit of it is covered with that. And otherwise, our favorite fixed deposit is always there. So that is some portion of debt that gets covered. Equity is the most asset class which we need to push for, and which is why we keep seeing all these education around equity, because that is what is needed most. So by nature, debt is safer because you're lending money to either a bank or a company or a set of companies or to the government. So whoever you are lending money, so when you're lending money, you're assured a sort of guarantee in some cases, or you're assured a certain amount of return. For example, it will be lower, it will be closer to inflation. In most cases, it won't be higher. In case it is higher, it's not something to be happy about, it's something to worry about, because that means that the investor has to take on more risk, is taking on more risk to generate that return. In fact, when we see FDs which are paying higher amounts, higher returns, it's something that we don't want to take that risk, because obviously they're not able to raise money at lower rates. So we have to be careful about the asset class that is giving us higher returns. Most people tend to get swayed saying, okay, FD is giving 10% here, so I'm going to go and invest there. In fact, it should be the opposite. Debt should be for safer reason and not for the growth reason. In equities, of course, by its nature, it's risky because it can grow. One of the ways to cut down that risk is, of course, diversification. The second is to give it time. But this is one asset class that can give you a longer term return and higher return than any other asset class, so to speak. Let's not go just by the shorter version that we're seeing, last 6 months or last 3 months, what returns gold versus an equity may have given, because by nature, equity is a long-term asset class, right? It's investing in businesses. So that is why we should look at all these three for different reasons and for different time horizons. In fact, debt should be there for short term as well. But unfortunately, most of us look at equity for short term, saying, can I double my money in 6 months, or the stock has doubled in 6 months. But that should not be the idea when you're investing. Whether it doubles or not, the idea is to make sure that you're invested in it for the longer term, because that is when you will continuously and consistently get good returns.
Thank you very much, Shweta, for joining me here on the Money Mile and sharing your thoughts on this very important series where we seek to educate investors about how they can go about their investing behavior. Thank you very much.
Thank you, Vivek.